Good evening, everybody. All right, tonight we got the great pleasure of having Marc Sachs with us. He is very adept at showing how to see where the institutional money is coming or going into a price trend. So because we're a little bit behind schedule, Marc, welcome to the Candlestick Forum. We'll let you take it away.
Hey, thank you so much. And listen, everyone, thank you for giving me this time this evening. Hopefully, you'll find this really educational, and I can provide you with some information that you haven't heard in the past. Just a quick disclaimer that we are not commodity trading advisors, that the information that we're presenting is for educational purposes only. Careful consideration of your financial position should be made prior to trading. Never risk more than 2% of your account in any trade. And we recommend that you speak to a registered financial advisor before making any investment decisions. With that said, let's roll forward. Just a little bit about myself. I'm a graduate of the University of Pennsylvania, former professor at Jefferson University in Philadelphia. And I've been involved in the financial markets for over 20 years, and actually over 25 if you include stocks. And I began trading the futures and forex markets approximately 10 years ago. And in my graduate school work, I was involved in the optimization of software systems, and specifically at that time, we would look at closed systems and optimize them using multivariable equations, and what I did was optimize underwater decompression schedules for the U.S. Navy. But the principles involved in optimizing any closed system are exactly the same. Every single financial market is nothing more than a closed system. The future movement of price on any financial market is governed by certain specific independent variables. It is our goal to define those independent variables. You place them in a multivariable equation, and when you optimize them, they then have the ability with great precision to determine the future direction of price on any given financial instrument, on any trading chart, and on any time frame. What we do is look for leading indicators, not lagging indicators, a way to provide you with a leading assessment of the direction that price is going to move out into the future. And really, it's those governing principles in which we created right line trading. Now, there's a real problem with current technical analysis, and that is that 95% of day traders fail. And obviously that would be unacceptable in any other field of endeavor. I mean, if there was an architect that architects put up buildings of which 95% of them collapsed, or doctors treated patients and 95% of their patients died, that would be unacceptable, and it would be reasonably unacceptable. And what would happen would that scientific analysis would be brought to bear on each of those disciplines, and that analysis would determine what exactly are the governing principles that are causing these endeavors to fail, and those particular principles would be teased out, and which of the principles that they're using actually are helpful and allow the process to succeed. And those particular elements would be expanded upon. But what happens with current technical analysis, for some reason, it's not considered a science. If you look at all the major schools of business in the country, there are departments of finance, departments of business, but there's no department of trading, department of technical analysis, a department which looks at indicator analysis. And And so there's really no advancement in the science of technical analysis based on any really good scientific studies. And the problem because of this is that each generation of day trader fails to learn from the previous generation of day trader. And it's the same thing with swing traders. What they do is they use essentially the same technical analysis that caused the whole previous generation of day traders to fail. And so this process is perpetuated over and over and over again. The key here is to not accept any current dogma without mathematical verification of its accuracy. You need to know that the crossover of an oscillator signal is going to provide you with enhanced precision in as much as it gets you a trading entry that has a greater probability of winning. Now, if you do a Nexus Lexus search of the world literature, you will find there's almost no really well done scientific analysis of any current overall technical analysis or any of the indicator analysis that we use. So what we did at Rightline was to look at each of these indicators. Now, what we found, I really boiled down, and to make it quick, is that an oscillator is a lagging indicator. It is not going to tell you where price is going to move out into the future. It's only going to tell you where price has been. A MACD crossover, a MACD is really an elegant indicator. And intuitively, you think it might have some value. But again, it's a lagging indicator. It only tells you where price has been. It doesn't tell you where price is going. And these things have no validity if you're going to use a crossover or a signal from an oscillator to get a trading entry. And we all know that oscillator divergence and MACD divergence are very, very, are signals that oftentimes fail. They don't have any great degree of reliability. We all know that an oscillator can remain overbought for an extended period of time. So these just don't help your trading. And Fibonacci was an 11th century mathematician who created Fibonacci transformations, of which he derived Fibonacci numbers. They're really elegant. And he developed that analysis 900 years before the development of any stock market or financial market. Now, some brilliant guy got the idea of taking his analysis and taking his numbers and throwing them into the stock market and felt that somehow they would be able to predict the future movement of price on your trading chart. And that's totally bogus. We did 2 years of market replay data looking at Fibonacci areas of support and resistance, and Fibonacci has no mathematical validity for predicting the future direction of price. And if you use it, you trade off a Fibonacci support or down off a Fibonacci resistance, all it is going to confound your trading, decrease your precision, and you're going to collect a lot of losses. Forget classic Elliott wave. I've never seen anyone traded successfully, or Fibonacci for that matter. So what fundamentally is responsible for moving price? What are independent forces that are brought to bear on any given financial market that we can leverage to tell us where price is going to move out into the future? One is the multi-time frame analysis of trend. Now that is really, really a key analysis. I'm going to show you how it works. But when you trade, when there's a multi-time frame alignment in trend, the predictive value of a trading entry skyrockets. Because there's only one thing that allows multiple time frames to align, and that is the application of institutional money to your financial instrument. Left to their own devices, all Markets want to move and chop. No single market is going to trend without the use of without institutional money coming to bear, and you're not going to get a multi-time frame alignment in trend unless there's a significant amount of institutional money at play. Now, you also want to look at the multi-time frame direction of correlative markets. I'm going to show you what correlative markets are, but they are a direct track of money flow. You want to look at the multi-time frame analysis of order flow. And I'm going to talk more about order flow, but it's basically telling you what's out there on your dome. Is there an excess of buyers or is there an excess of sellers? Is there buying pressure on the market or selling pressure on the market? The multi-time frame analysis of momentum, and we leverage volume using market profile. And you're going to see our analysis of market profile is really a leap forward. Now, this is called our three-line indicator. We eliminated one line, which is the stochastic line, which is useless. And we still call it the three-line, even now there's only two lines. The top line assesses the multi-time frame direction of momentum. Now, when it's red, the two higher time frames than your trading chart have momentum to the downside. If you're trading a 3-minute, the indicator assesses the 9-minute and the 27-minute. If you're trading a 5 range, it looks at an 8 range and a 13 range. If you're trading a 377 tick, it looks at the two higher fib numbers. And Fibonacci does have symmetry, but it cannot predict the future movement of price. When it's red, when it's green or blue, you have a multi-time frame alignment to the downside. And these are really two important independent variables. Now, there are lots of ways of assessing momentum. Our oscillator assesses momentum, MACD assesses momentum. What we do is we use modified Heikin-Ashi to assess momentum. Now, you want to trade when the multi-time frame assessment of momentum and the multi-time frame assessment of order flow align. When you do, you get a very low risk, potentially high reward trading entry. Now, order flow is simply, is there abundance of buyers or an abundance of sellers on your trading dome? I mean, what is happening? Is there buying pressure or selling pressure? And on any given candle, it creates a delta, and the delta is the difference between the buyers and the sellers. What we do is we put that individual candle delta in a moving average, and we create a delta moving average of your two higher time frames. And if you trade against the direction of momentum and order flow as assessed by the two higher time frames than your trading chart, your likelihood of getting stopped out is exceedingly high. Now, this is an area of resistance that's created by market profile. As soon as price breaks resistance to the upside, the only direction you can take the market is long. Now, you don't know the time frame because it's irrelevant. You don't know that if this is a stock, if this is a Forex pair, or if this is a futures market, because it doesn't matter. The only direction you can take this financial instrument is long. And all the traders in these orange candles, counter trend trading, the direction of order flow and momentum, are trading oscillator divergence, MACD divergence, off of Fibonacci resistance, and they're all getting stopped out. Here's the same thing. Order flow and momentum align, and price follows. And remember, which is something that's very, very important, price rising is not turning these indicators green. These are green because of the two higher time frames, and therefore price is going to follow the direction of the two higher time frames. So unlike most other analyses where rising price creates a green. Here the green is creating the move, the move up in price. Now, I don't ever counter trend trade, but if you want to do it, the only possible opportunity is when order flow and momentum shift in direction. Now, what happens when order flow and momentum don't align? Since they're both equal in power and they both have significant influence on price, what happens when momentum, which is the upper line, is aligned to the downside, and order flow, which is the bottom line, is aligned to the upside? And what happens is the market chops. And really what a chop market is when real independent variables, the assessment of true forces on the change in direction of market price don't align. And when they don't align, they predict with great clarity that you're going to wind up with price chopping. When the indicators align is when price really beats it to the downside. Now, we are not talking about a trading entry. We're simply talking about a market direction, a directional bias. And let me tell you, that's 75% of trading, is understanding the direction that you must trade in order to get a winner. Here's the same thing again. The markets don't align. Order upper is momentum, bottom is order flow. They are moving in separate directions. Price simply chops. When there's an alignment, price goes to the upside. And if you try to counter trend trade, this indicator analysis, you're going to get stopped out. I trade these markets every morning in a live trading room, and I never trade against a direction of order flow and momentum. Now, the multi-time frame analysis of trend, I think, is one of the most powerful independent variables. And there's actually a mathematical theory called the nonlinear association of independent variables that tell you that not every force that's independent in nature is equal in strength. The multi-time frame alignment of trend, I think, is the most powerful. And if you trade when there is no multi-time frame alignment, you assume a tremendous amount of risk. And when you trade when there is alignment, your risk plummets, and the direction that you must trade is really clear cut. Now, on this chart of crude, we have this pink background bias. So what is it analyzing, and why is it pink? On most software systems, when price falls, the background color goes green, goes pink. It's simply because there's some kind of MACD crossover or oscillator crossover, and it's telling you where price is going, but not where it's going to go out into the future. It's telling you where price has been. What this is doing is assessing the 8 range and the 13 range chart and ignoring price on your trading chart. And what it's telling you is the 50-period simple moving average and the 15-period moving average on your 2 higher time frames are red and angling down, and the 15s cross the 50. The faster moving averages cross the slower to the downside, and price has broken below both the 50 and the 15 on your 2 higher time frames. So support has broken. When that occurs, background bias on your chart goes pink. Now that tells you that you have a terrific multi-time frame alignment on your higher 2 time frames. 50's down, 15's down, 15's cross the 50 to the downside, and price is below the 50 and the 15. So the only direction that you can trade is short. And that's all this is telling you, is that your 2 higher time frames are aligned to the downside. You've broken support to the downside. And if you try to go long here, you're almost guaranteed to get stopped out. And you can see all these traders, counter-trend trading, using their oscillators, their MACDs, and their Fibonacci, and whatever else, and they're all getting run over. Our direction is short. So now we have three ways of determining the direction that we must trade: order flow, momentum, and the multi-time frame alignment of trend. Now here's an alignment to the upside. This is the E-mini. This is a 14.25 point move to the upside. This is an 11.75 point move to the upside. But the fact is, the size or the magnitude of the move to the upside is irrelevant. All this is telling you is that you've got to trade long. And if you do, that your entry is going to be extremely low risk and the potential profit is going to be extremely high. Now, I'm not putting it all together for you yet because you don't know the direction of order flow and momentum. But it's likely that they've aligned because it's only institutional money that's going to create this multi-time frame trend. Now, correlative markets are really a unique analysis that we do. And it took us a long time to work this out. Now, what you have to understand is that in the course of a given day, obviously, stocks go up and stocks go down, and Forex pairs go up and Forex pairs go down, and futures go up and futures go down. The key is that in any given market, there's really a finite amount of money. And what the big institutional guys do is simply they just simply rotate that money from asset class to asset class. And what we do is we track their rotation of money from asset class to asset class. Now, the last set of indicators we looked at higher time frames in your trading chart. This analysis looks at different markets. Now, if you're trading the NASDAQ or the E-mini or the Russell or the Dow, and risk is off, the big institutions are going to pull their money out of stocks because they don't want to take risk, and they're going to move them into safer investments like treasury bonds, treasury notes, certain currencies, and certain precious metals. So what we look at are correlative markets. If the E-mini falls, the NASDAQ, the Dow, and the Russell are likely to fall. In fact, they're likely to fall with a 70% probability or greater. Treasury notes and treasury bonds are likely to rise with a 70% probability or greater. Certain precious metals and certain currencies are also going to rise. So when all the markets that fall, that are supposed to fall, and all the markets that rise, that are supposed to rise, when your trading chart comes down like this, you're actually looking at the rotation of institutional money from stocks or futures as an asset class to a more safer investing vehicle. Now, here is bonds. And bonds has 6 correlative markets. And remember that price here we're not even assessing the direction of price on bonds. We're assessing 6 markets, 6 correlative markets. And I can tell you one of them is treasury notes. Now, when all 6 markets are green, it means that money is flowing into bonds. And you can see that price rises on bonds. When these 2 lines are green, money is flowing into bonds. And you can see that price rises on bonds. Now, we've defined the fact that when order flow and momentum don't align, the market chops. What happens when the institutional guys are not creating a scenario where they're pushing money into one financial market and pulling it out of a group of others? What you get is chop. When these 2 lines are yellow, price just moves in just a random, chaotic fashion. So when there's no alignment here, when there's no alignment on order flow and momentum, and there's no alignment on the multi-time frame analysis or trend, the likelihood of the market chopping is high, and that's when you're going to stay away. When everything aligns, you're going to know the direction to trade, and that direction is likely to get you a winner. And the potential for a big winner is high. Here's the same thing. When I showed you this chart before, this showed you the background bias and the trend alignment. This is the E-mini. We have 9 correlative markets, 3 in each line. Money flow starts into the E-mini, and it pushes the price up, It also creates the multi-time frame alignment. I'm just going to skip this. Now here's market profile, and our market profile is really powerful and very, very unique. It's based on really sound math, and it's very, very important that you leverage it. If you take any set of data and it's randomly distributed, it will naturally form a bell-shaped curve. And in this particular case, we're looking at price on a financial instrument over time. This is the mean price, or where most volume is traded. And when you have a perfect bell-shaped curve, the mean, the median, and the mode are all the same. That's a very powerful line. And it defines an area of fair value or fair market value. And I'm going to show you what that means. Now here is our market profile. Now our market profile is really powerful for 2 reasons. One, we do a volume look back. We don't really use the histogram, but we use the data from the histogram to create these areas. And we do a proprietary look back period. Remember, 1 day is never enough data to give you the kind of precision trading that you need to make money in any market, whether it's stocks, Forex, or it's futures. Now the value price wants to stay within fair market value, which is the area between the value area high and the value area low, and this encompasses 1 standard deviation's worth of volume, 66 2/3% of all volume at price crosses and defines fair market value for that trading instrument. Now, when price approaches the value area high, it's going to be pushed down. When price approaches the value area low, it's going to be pushed up. And the point of control is a real powerful area. This is the area that most traders to trade this financial instrument. This is crude, $53.49 was where traders most often wanted this price to be. I personally will only short a stock or a Forex market or a futures market below the point of control, and I will only go long above the point of control. To me, it's a benchmark price. Now, besides the VAH, VAL, and POC, you also have low volume nodes. Now, these low volume nodes are at prices that are just the opposite of the point of control. The point of control is where everyone wants to trade crude, the E-mini. The low volume node is where nobody wants to trade the E-mini. So price is pushed down by the VAH, pushed up by the value area low, and is rejected by the low volume nodes, which we have defined specifically as those nodes that are confluent to the VAL or the VAH. And what they do is they provide these zones of rejection. And you simply can't, with any degree of safety, trade into a support zone or trade up into a resistance zone. Because these are prices, these are where prices are going to get rejected and pushed down. Nobody wants to trade this price. And here, price wants to stay within fair market value. So you can trade inside here, but not up into it or down into it. And when it breaks through, this is where you get big runners. Now, price hits, rejects, eventually breaks support. And when it comes up to resistance now, you can see here's where you can get a potential for a huge runner below the value area low. And you can see the market really just takes a tumble here. Now, we're not looking at the multi-time frame alignment of trend. We're not looking at money flow. We're not looking at order flow and momentum. We're just taking trades off support and resistance. Now, if you add order flow only, when you break support here, order flow is red, you can only go short. Hit support of the point of control and you're out. And just let it blop around here. Order flow turns green. You can take a trade off the support of the point of control. At some point, it's going to come back and stop you out based on your trailing stop. You wait for support to get broken. It comes back up, and the point of control acts as resistance. And order flow and momentum, or as order flows aligned to the downside, you can only go short. And here, you have to wait for order flow to turn. It's going to take a little bit of time, but eventually you can trade long off of support. Trying to trade in any other direction is real likely to hand you a big loser. Now, what we've also done, and this is Sierra charts, is we've created an intra-candle volume profile. And this took us months. And what this shows you is where all the hidden areas of buyers and sellers are located. Now, what you're looking for on a long trade is this yellow tick level. It could be a tick level, or it could be a cent level on a stock, or a pip level on a Forex pair. But this shows you that this is the price that in which most volume crossed on this candle. And this is called the commitment of traders, or the COT. And when the COT is at the bottom of the candle on a long trade, you have a perfect setup based on volume to take a long trade one tick above the close of the candle. You'll notice the background bias is green, the 15's above the 50 and the 15 are both heading up, and this is the value weighted average price. I'm sorry, the volume weight, the VWAP. You're trading above that. Here is the point of control. You're above that. And here's your short trade. Now the 15 has just not quite crossed the 50, which is not good. But the reason you can take this safely is because the commitment of traders is all the way at the top of the candle on a short trade. And when the commitment of traders on a short trade stays at the top, it almost guarantees that the trade is going to continue. You'll notice the COT is here on this candle. It's here on this candle, all the way at the top. But here, it's moved to the bottom. And I don't know I'm sorry I cut this off, but here is where you might start watching closely about how the trade is going to evolve. But as long as it stays here at the top on a short trade, you're in great shape. And what you look for around the COT is intense selling. Right here, intense buying, that light green. Right here, intense buying, light green. So there's a way overabundance of buyers at the level of the COT, and that also augments the ability to take a long trade, a real safe long trade. Here's another trade. Now this is a terrific pullback to the support of the value area low. And if you look, the COT is almost at the bottom tick of the candle. That's a tremendous signal that you can take a long trade back into the direction of the trend. Now, when you come up to the VWAP here, you have to be careful because it's an area of resistance. What tells you that you're likely to break resistance? Well, it's the commitment of traders. The commitment of traders is close to the bottom of the candle as it moves into resistance. And it just snaps resistance. And it continues to move up. And you see as the trade peters out, you're going to see the COT starts to move up on the candle. So this gives you tremendous insight into when to take a long trade, when to take a short trade, and where buyers and sellers are sitting in that candle. Here's one more trade. This is on the E-mini. The COT is all the way at the bottom. This is a little bit of a riskier trade because you're trading up into resistance. But the COT off of this pivot gives you the ability to take a long trade, and it's a real successful trade. This is a real powerful signal to take a long trade. But remember, you have background bias. This is not the dark green. It's blue or cyan. It's a different power, but it's still a multi-time frame alignment to the upside. COT's at the bottom, almost at the bottom. Here the COT starts to rise. And eventually the trade peters out. And the candle that reverses has the COT at the top. Now our cash metrics are another indicator that nobody else has. And what we do is we take 16, it's not 21, we booted 5 out because we didn't like them and they weren't helping us, so we eliminated them. So we take 16 indices and we divide them into 4 groups. A group for the Dow, a group for the NASDAQ, a group for the S&P 500, and a group for the Russell 2000 index. And what we do, now these are those indices. These are just some of them. There's the semiconductor index. We look at all different internal metrics of the markets you're trading. These are incredibly good for stocks and really good for futures. And what we do is we look at the ratio of up volume to down volume, the ratio of advancing issues to declining issues, the ratio of stocks upticking to stocks downticking. And then we hone it down to specific ETFs or things like the semiconductor index. So we're looking at what's making the market tick. And this is a real leading indicator. It really is going to tell you where price is heading, not where it does show you where price. I mean, you don't need an indicator to tell you where price has been because you can see, but this tells you where price is going. And it allows you to do really pretty powerful things. Now, the upper data are the 8 indices that we look at that are based on ticks. And the 8 volume metrics are in the lower line. And for some reason, I don't know why this is, the tick data tends to move faster. Like the colors change quicker, whereas the volume data tends to change slower. So before I even show you a slide, think if you want to take a long trade on your trading the NQ futures. Wouldn't you like to take a long trade on the NQ futures market when the internals on the NQ cash markets are all aligned to the upside? There's a tremendous correlation between the direction of price on a futures market and the direction of price on its correlative cash market. If you want to trade the E-mini, don't you want to know the direction of price on the S&P 500? Well, you're going to get the internals on these markets, which give you a tremendous heads up on how to trade futures. If you're going to trade a stock, don't you want to know what the market internals are telling you? Do you want to take a long trade, say on Netflix, with all the market internals aligned to the downside? Now, I want to qualify this by telling you that every individual stock has its own relative strength. And sometimes, despite market internals, a stock will have such strong relative strength, it'll just rise on its own anyway. But if you wait for this to align and you monitor 100 stocks, the predictive value of taking a trading entry is incredibly high. It allows you to trend trade, to trade gaps, to trade the market open, and it does give you a handle on reversals. Now, first, I'm going to get rid of this. I mean, we made 565 this day in the trading room. I'm not even going to talk about it. Let's take a look at Facebook. Now, all that matters on Facebook is the risk to reward. Now, these are the quants, and these are giving you those 16 metrics. This is order flow and momentum. Here's your entry. And you go up, and you get 40 cents on 10 cents of risk. Here's Perrigo. It's a generic pharmaceutical company. Notice the background bias is green. You're trading off the support of the value area high. Up you go for 75 cents on 10 cents of risk. Here's Tesla, down 65 cents on 15 cents of risk. These are all trading in the direction of the cash internals of the NASDAQ. Here's Netflix. This is a gigantic move. And remember, this background bias is not pink because Netflix is falling. Netflix is falling because the two higher time frames are aligned to the downside. The cash metrics and order flow and momentum are giving you the down. Now, I just scaled it to here. If you wanted to take a little more risk, and this is 99 cents, you could have made over $2 on this trade on 15 cents of risk. Now, this is on Akamai. It's a 60-minute chart. Traders always ask me, can you swing trade it? Can you trade longer-term time frames? And you absolutely can. This is a 3-day trade that nets you $1.05 on a stock that's very moderately priced. Here's Garmin on a 5-minute. I didn't scale this for how much money you would have made, but it's really significant, and the risk you're taking is very small. Here's NVIDIA, down $1 on 10 cents of profit, $1.08 on 10 cents of risk. You'd have to get 10 losers in a row to eclipse this one winner. Now, there's a lot of junk out there about how to trade a gap. And I'm going to tell you how to really trade a gap the way a professional trader does based on scientific principles. The market, a pre-market gap is created by the commercial traders like us. The institutional traders don't trade pre-market. And if Best Buy is gapping down pre-market, there's no way you can assess the quality or whatever of this gap because it's created by light volume and it's created by the non-institutional traders, the small traders like you and I. So what we think is irrelevant because when the market opens, the institutional guys are going to tell us what really matters. And with the market internals aligned to the upside, we're likely to see a gap up and a run. And so you can trade gaps at market open with great precision if these align. Oftentimes they won't. But when they do, you've got a great trade. Well, it just takes a little bit of patience, that's all. Now, this is a trade on optokinetics. That's a trade, I have an options newsletter, which is really, I don't want to tout it, but it's really doing awesome. But anyway, optokinetics gaps down pre-market. Then you have to decide what you're going to do with the gap. Do you think the gap's going to fill to the upside, or do you think it's going to continue to run? Well, the cash metrics finally roll to the downside, and you're just going to trade the gap down because the institutional guys have rolled 16 metrics to the downside, and this stock is going to collapse. Now, here's how you can buy a gap and market open. When they're aligned, those 16 metrics, this is CNX, and I think this is the Canadian National Railway. I traded a long time ago in the options portfolio. We made nice money on it. It's a 60-minute chart, so it's a multi-day trade with the cash metrics aligned to the upside. You take the trade at the market open, and the stock runs for 2.5 straight days. Not every candle's an up candle, but as long as the cash metrics remain in your direction, you are safe, and just continue to let the trade roll. And here's sort of a gap down, but it's a market open trade on Facebook that really makes you nice money at the open. And it's a 2-day trade. You're in on 9/8 and you're out on 9/11. It's a 1-hour chart. Here's a trade on the NQ, trading in the direction of the internals of the cash NASDAQ for 9 points. Here's a move to the upside on the E-mini, trading in the direction of the cash S&P 500, which has all its internals aligned to the upside, and up you go. Market open on the E-mini, 7.5 points. And it's a great way to start the morning. Get 7.5 points and just go back to sleep. And if you get a 7.25 trade when on a market open, you should close up and mow your front lawn, but don't take another trade. Now, let's take a look quickly at specific entries. These are smart entries, and our auto trader system uses these entries, and we use these entries. And these are not dumb entries. I'll show you why they're smart entries. Now, a strategy entry is this red square. It's actually an X, but I made it so big it got blurred and created the X, the square. This is a multi-time frame of assessment of market structure and price action. It only triggers a short entry when the 50 and the 15 are down and price on a short trade is close to resistance. We look at these carefully. Because you need a multi-time frame alignment to get a strategy entry, you can go a day or two without seeing a single entry that is a strategy. So when we see one, we look real carefully. We do kind of our due diligence on it, and if it works, we're in, and it usually calls a nice trade. Here's one to the upside, and here's a strategy to the downside. It's not looking at an oscillator crossover, a MACD crossover, or any confluence of indicators. And there's the traders out there, and they're called the just one more indicator trader. And what they're doing is they're on the search for that one more additional indicator, that if they get that indicator, they're going to get rich. And the fact is it doesn't exist. It's that holy grail indicator, because indicators are not going to get you there, especially those that simply pull in the direction of price on your trading chart. Now here's our ABC entry. I don't want to run over, but the A is defined by any two candles of the same color in a row. The software creates the A. The B are counter trend traders doing what I don't do, and I'm telling all of you not to do. Take a counter trend trade. Decide this is an up candle, which I have elected to color as magenta. There's no reason why this should be called as a bottom, but everybody in this B candle are calling a bottom here. Then you get an audible visual alert. The C starts to flash. You're in one tick below the close of the C. It's pushed down by two forces. One, additional sellers coming into the market because you're trading in the direction of institutional money. And two, by stopping out everyone in the B. You're overrunning it. And I know Steve is very big on Japanese candlestick patterns. The C engulfer is a real powerful Japanese candlestick formation, and it's extremely effective. Here it is again. The engulfer to the downside in the direction of the trend. Here is it again. Down and up. Both times 50 and 15 are down, 50 and 15 are up. And I don't have the higher time frames or anything else, but these are very low risk, high reward trades. Now our consolidation is really a great entry. Now consolidation is defined by me, actually it's defined as an area where volatility drops and the power of the bulls equals the power of the bears. Here's an up candle, here's a doji. Here's a down candle, here's an up candle, here's a down candle. Here's an up candle. Volatility's dropped in this channel, which is defined by the software. It's a 12-tick candle body channel on an 8 range. I'm sorry, on a 5 range. I think it's a 10-tick candle body channel. Every other trader has to wait for the break of consolidation or this candle. We predict very accurately when consolidation is going to break simply by looking at the two higher time frames. They're going to call the break. The software creates this entry. The automated trader takes it. We take it, and we get a really nice win. Now, I put this here because sometimes it fires a little bit early, but it's unlikely to stop you out. If you're in on the first consolidation signal, you take a little bit of heat, and then up you go. And you can see all these channels. That's the software creating the channels. But because it's a multi-time frame look at, it's assessing multi-time frames, it doesn't give you an entry. It's simply assessing the channel. But it's telling you, up here, we're too far off support. Up here, the modified 15 is yellow. We don't trade a yellow. Over here, something's wrong. There's no entry. So it only gives you an entry when price action and market structure align on multiple time frames. Now, this trade worked. And sometimes when you have a lot of precision or specificity, winning trades get by you. But what it gives you the ability to do, which is key, is avoid all losers. And I got to roll really quick. It's 9 o'clock. I don't want to run over my time. I just want to tell you this. The fundamental goal in day trading is not to get winners. It's to avoid losers. Now, I'm going to skip all these. We don't have time for them. Let's just roll through. Really, they are just trades aligning with all of the information that I already told you. Now, we have 2 quick testimonials. I'm not even going to read them, but one is Jersey Tony. He's been with us about 3 years. He's a top step trader. His performance is published, and he has made an amazing amount of money. The other one is Trader D. Trader D was the 2016 Top Step Trader winner in the $50,000 combine. He made more money than anybody else in the country, $54,000. He trades our software, and he took 21 straight days without a loser. And his first paycheck came really quick. He made $3,000 as a payout off a Top Step. And he just goes into how trading our system provides him with that advantage to get all these winners. I'm not even going to do this. Go through this. And now here's our indicator special. Bonus one is our trade execution platform. We have our own execution platform. And I don't have time to show it to you. But it's an amazing tool. It's a patent pending piece of software. Everyone says it's proprietary. This really is proprietary. It's filed with the patent office. It's been pending for 2.5 years. We're waiting to hear. It's going to get you into a trade with less slippage and with greater precision. It's an amazing entry tool. You get 3 months in the live trading room with me, the master trader, and I do make money almost every day. Not every day, but almost every day. This is not 12 weeks, it's 10 weeks in our trading school. And you get access to our library, which is 400 videos. Now, you also, for the first 5 orders, you get our automated system. I can't put the link to the performance of our automated system into the room. But today, on Monday, the automated system made $700. On Tuesday, it made $250, and today it made about $400 and change. So for the week, it's up about $1,300 this week. It trades the E-mini, the NASDAQ, gold, crude, and the 6E. It takes all of those system-generated trades, and we get to pass or play on every automated entry. So what you can do is create 2 independent revenue streams. You can just sit and let the algorithmic trader automatically execute the trade on your dome and manage the trade all by itself. It has an adjusted automated trade management strategy based on market volatility. It is really a seriously powerful auto trader. And the first 5 get that as an add-on for nothing. So here's our email, that's our web address, rightlinetrading.com, or info@rightlinetrading.com, and here is our phone number, 786-713-5276. And we've spent 2 years creating the automated system. Now let me see if we any questions. Sophie, the C engulfer is just a C candle that engulfs the previous candle. Hang on a minute. Great, thank you. You know what? Let me just go to the beginning. It doesn't make any, the time frame, it doesn't make any difference. Whoops. It makes no difference whether you're looking at daily bars. Some people trade daily. Some people trade 4-hour bars. Some people trade 3-minute, 4-minute. It doesn't make any difference. I trade an 8 range, a 5 range, a 13 range, and a 21 range. It is totally irrelevant. Makes absolutely no difference. It works. The multi-time frame alignment, Ray, is 3 time frames. You're right, Rick. It's supply and demand basics analyzed in detail. That is exactly what it is. Gary, I wish I could show you how it looks on a live chart. Basically, the full JPEGs are exactly how the system looks on a live chart. Today, in the live trading room, I took 2 trades and we were done with $565 of profit on 2 trades in 35 minutes. I took a winner on the NASDAQ that went 33 ticks, and I took a winner on the E-mini that went 2 points. Those 2 trades gave us $565, and we were done. And that was 5 minutes after 10 this morning. What we got was a multi-time frame alignment and trend, order flow, momentum. We had I can't remember the entry that we took. I think it was a consolidation on one, a strategy on the other. Very, very low risk trades, and they just flew. Yesterday, I made $350. We hit it. Our goal is to make $1,000 a week in the trading room after commission. to give you $50,000 a year or $52K a year on a small account. I'm sorry, John. Okay, hang on one second. I didn't. I clicked on the private message, but I don't know how. Yep. Okay. Well, listen. No, listen. We take losers. Moneyball. We have losing days. Believe me. It's just irrelevant. It'll work. Jackie will work with any broker. We're active on two systems, Sierra and Ninja. It works on all time frames, Dan. No, it runs on Sierra and Ninja Trader. Okay, listen, everyone. Thank you for the questions. They were great questions. It's based on both, Warren. Ninja Trader 7 or 8, Bruce. Either one. It works on Thinkorswim. Now, okay? Okay, everyone. Moneyball, have a nice night. Sweet dreams. Everybody, thank you so much. Steve, thank you so much for having me. I'm sorry that I ran over, and thank you. Listen, whatever you do, I wish everybody in this room, the best of luck. We're the small commercial guys. Let's make money, and let's take the money from the other small commercial guy. Have a great evening, and again, thank you all for hosting me. Take care and have a great evening. I'm going to log out. Bye-bye, everybody.
Thank you, Mark. Good stuff. Everybody.